So if we want to apply hedging, right, that's going to be the next question. So we got our tool, we've made the decisions, we're looking at trades and whatever it is. Well, the next question becomes, do I want to apply hedging, right? Okay, well, number one, what is hedging? That's a big question for a lot of people. A lot of people are like, no, I know what that is. So if you don't mind, I'm just going to run through some basics real quick for those of you who may not. So hedging is a risk management strategy that can be implemented to offset potential losses from a single investment or an entire portfolio. We are indeed going to run through this on the live chart today, by the way. It can act as a form of insurance on the actual investment in the event that it does not go in your favor, which is never ideal, right? So hedging is used by many institution corporations and, of course, individuals. Most hedging strategies involve a mixture or collaboration of equities, options, and or futures. And specifically options and futures, right? Those are going to be generally a very optimal hedging tool. I personally use futures. You know, not that that matters to you, but that's what I use, and all of our members know exactly how I do that. They see some pretty cool stuff. So, but anyway, one may have a large portfolio of equities and they're exposed to exponential downside risk, right? So remember the term insurance. So to mitigate this downside risk, he or she could short a relatable futures contract or sell an option call. Okay, so specifically, let's talk about that investment real quick, or portfolio, if you will. We're referring to buyers. Okay, so if you own a portfolio of equities and you're not shorting them, you just own the portfolio. We'll walk through some examples of that here in just a moment, but that's what we're referring to. So if you've bought up, you know, a portfolio of equities, you know, an option there would be to short against that and or hedge a relatable futures contract or an options, sell an option call. So here's an example for you. Let's call it investor, okay? It could be investor A or whatever you'd like to say there, but just investor. So the investor has a long portfolio. They bought it expecting for price to go higher, which is what, you know, I would say almost everyone does, right? In the equity world especially, generally buying equities to go higher as an investment or trade, of course. So it could be day trade, could be long-term trade. Okay, so the investor has that long portfolio consisting of 5 top stocks in the S&P 500, including Microsoft, Apple, Amazon, Facebook, and Google. Remember, this is an example here. And the investor is 100% exposed to downside risk, and they could lose a substantial amount in the event of a down market. I think a lot of people figured this out back in February. So that's the most recent example I can get. Of course, the financial crisis, I mean, they're going to happen, yeah? But those are the latest, off the top of my head, especially back in February, was pretty rough. But we applied exactly what you're going to see today back in February, ended up being just an absolutely amazing year. And it's unfortunate for a lot of people, but not now. I mean, we're back making all-time highs, you know, so it's a great thing. But the point is, you can be heavily exposed to the downside. If you own those stocks, right? Microsoft, Apple, Amazon, Facebook, and Google, you're probably feeling pretty good because those are amazing companies. But you're still exposed 100% to the downside. So the investor sells short an S&P futures contract to offset his or her potential losses. As a result, in a down market, the investor would gain profits from the short futures contract, that is to say from the hedge position, which would offset all or some of the losses from within the portfolio, those equities, okay? So again, it's like an insurance on, you don't want it to go against you, right? In conclusion, hedging may indeed it may indeed reduce the ROI, which is an acronym for return on investment. I'm sure you all knew that, in a consistent bullish market. So if I'm hedged and the market just keeps on going up, I might want to consider removing that hedge, as there's no real point in it, right? So it could indeed reduce your ROI on the way up. However, if the sentiment were to turn bearish, the hedge position would substantially benefit and could save a lot of capital. So hedging, this is important, can be applied to both short-term and long-term trading.